now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show. And we are back with the unemployed value Degen. Steve, how you doing today?
I'm doing very well. Thank you for having me, Daryl.
It seems like this unemployed journey is going well for you. You know, you reached
Yeah.
4,000 plus subscribers. How's that looking for you?
Well, my Substack can pay my half of the mortgage. My wife pays half and I pay half. So it's turned in some people said I need to change my name, but now it's kind of a brand. So I'm self-employed value degen now. But yeah, so
Yeah, yeah.
Substack is working. I do need to raise prices though. I think I'm going to go from $5 a month to $7 a month.
Yeah, and there's a lot of value there. I've gotten multiple ideas, companies. I mean, you're putting out stuff constantly. You're constantly researching around the clock. There is no shortage of companies that people can read your research, do in your due diligence on it, do their own due diligence, and consider whether or not they want to invest there.
Yeah, no, it's a lot of fun because I would love to research these things just from investing my own savings and my wife's savings. Our savings were not quite enough to warrant full-time research, so Substack's really been great for that.
Yeah, yeah, for sure. For sure. So yeah, let's go ahead and jump into some just a little bit of macro. I don't want to spend too much time here, but there's been some huge news, war breaking out, Iran, Middle East, and such. And oil prices did spike recently. Gold prices spiked, came down a little bit. I'm expecting that. I mean, at the time of this recording, it's Sunday. Market isn't open yet for Monday, and so I'm expecting that we may have another spike up, and especially depending on if Iran responds and whatever the case may be. Um, how is this factoring into how you're thinking about the markets right now and investing?
Oh. Yeah, just when I think it's time to write a macro piece, then Trump goes and bombs Iran. So I don't know how much of this is sort of uh, how much of it's for real and how much of it's performative, because you see these strikes back and forth between Iran and Israel, and they always make it a point to do it on the weekend when the stock market's closed. And the bunker busters that we just dropped on Iran, they can penetrate about 50 meters deep. And I've read that those uranium enrichment facilities are 600 meters underground. So I think there's a chance it was all just for show. And then you have and also the news reports were that there was the sensors detected no radiation. So I mean, if you're going to blow up an enrichment facility and then they don't detect any, fissile material in the atmosphere, it means they probably didn't really hit anything. And you have Russia come out and say, well, we could just give Iran some nuclear weapons. If you guys are going to bomb our ally as enrichment capabilities, we could just give them some nukes. We could do that. So I think this whole thing is I think what's going to affect the markets a lot is the same with the Yemen and the Houthis. So, um, it seemed like we were getting nearer to peace with Yemen and blocking the Red Sea and the Houthis, and then they said, oh, now they're reopening missile strikes again on ships. So ships have to go around Africa. It drives up day rates. Um, it's been a situation where I don't want to buy any shipping companies. I just wish I owned them before. You want to buy shipping companies when everything's geopolitically stable, and then when trade routes get closed off and the ships have to go farther and the day rates get higher, well, then they make all this extra money. And I thought that we were on the heading more toward peace. Trump had kind of positioned himself as a peace candidate, and then you have like in Ukraine, you had what's his name, Lindsey Graham and Mike Pompeo go to Ukraine. I don't know how they're not in jail for violating the Logan Act and, try and get Zelensky to escalate things so that there's no peace with Russia. It just seems like I was hoping Trump would be a peace candidate, and the world just doesn't want to seem to go in that direction, unfortunately. Um, but so I think what I've been doing is focusing more on US only, looking inwards, looking, insulated, looking at industrials that serve the US market with a US supply chain, looking at the financials that serve American retirees, because it's hard to know. And a lot of companies, they've been paralyzed with the tariff situation because, and especially trucking, you'll have importers want to import to get ahead of the upcoming tariffs. and then you give them a 3-month reprieve. And then, so now the new deadline is July. And you don't know if the volumes being shipped are kind of a steady state, or if they're trying to front run, or they're trying to wait and see. So now we have all of this uncertainty from Trump, and it's making the data really cloudy and hard to see what's happening. And when the data's, totally incomprehensible, things could sneak up on you. Like maybe we entered a recession 3 months ago and nobody knows it. I don't think we do. I'm just saying the data is so cloudy right now. You don't really know what's going on, because are they front running? Are they paralyzed? Are they waiting? We don't know what the economy even looks like anymore. So there's a lot of
And you
things I
mean by
do
that,
like
like,
about Trump, but this uncertainty and the stop go, and maybe that's necessary for negotiations, but it makes business tough.
yeah, yeah. And so when you mentioned data being cloudy, I know one thing with the front running of the tariffs, like buying um, products or materials in bulk to front run the tariffs was one thing, and that really impacted the GDP numbers of the recent quarter, as well as like imports of gold and such. And so, um, are you seeing that as like kind of that being one factor in like how this is making data look cloudy?
Yeah, and then on top of that, you have the data agencies. I mean, if you look at the employees of these government agencies, what percent donate to one political party versus what percent donate to the other, it's like 98%. And the world's kind of schismed to a world where, the Democratic Party is the party of government employees. And there are things they can do on the margin that, it's like with CPI. You have all these academics recommending changes, but the only changes that get approved are the ones that make inflation look like it's lower than it is. So it's on the margin. They fudge the numbers just a bit here and there. But yeah, the data is totally worthless. Nobody knows what's going on. Nobody knows if the economy is shrinking or growing. Nobody knows what the steady state is right now. So it's kind of no man's land. But I don't think we're heading toward any sort of serious recession, just from a traditional Austrian business cycle perspective, because the Austrian business cycle, you have low interest rates causing malinvestments, right? If interest rates are zero and money's free, people go and do stupid stuff with it. But we had interest rates at zero for 15 years while the US was sending its manufacturing overseas. So we weren't building any industry here to make malinvestment with. All the malinvestment turned out to be, apartment buildings in China, and they're digesting that. I mean, you have this weird scenario where the only thing that got done in the US for 15 years was Silicon Valley's venture capital, and most of that is equity finance. Because if you don't have debt, if you have low interest rates lead to malinvestment, okay, well, if you do an investment, it turns out bad. If it's all equity finance, then some rich people lose money and nobody cares. It's when it's debt financed that the banks get in trouble and it causes a financial crisis. So if our zero interest rate policy led to malinvestment in Silicon Valley, and then some rich Silicon Valley people lose money and nobody cares, then we're not really due for a bad business cycle. It's when you build physical stuff financed with debt and the banks get in trouble. And I don't think we're anywhere near that. If you look at leverage ratios going into 2007, if you look at the monetary base, which is, Jerome Powell and quantitative tightening, he's working on the monetary base. And you look at the total money supply in the system. Going to 2007, we were leveraged about 9-1. Just the fractional reserve system, there was about 9 times as much money as there was monetary base. After 15 years of, Basel 1, Basel 2, Basel 3, I think we're at like 3-1. I think we're only 3 times levered in the financial system. So we've delevered the entire financial system so astronomically. And one of the things Scott Besson is talking about doing is relevering that up, letting banks go, relaxing some of these Basel 3 rules and letting banks lend again. So if inflation's been pretty subdued while the financial system delevered from 9 times to 3 times. Imagine if we lever back up in the financial system and the banks start making loans again. I mean, the inflation would just knock your socks off. So I think that's the most likely outcome versus any kind of a recession coming up. But the data is so cloudy, I don't think anybody knows which way is up or down or what's happening.
And speaking to that, currently there's a lot of news about um, Japan and other countries selling U.S. treasuries, and right now there's like some type of restriction with the banks and how much treasuries they can buy. So are you referring to banks being able to buy and finance US debt to and then you get that kind of economic boom out of that because someone has to buy the debt to finance the deficits, finance the spending and all of that.
Yeah. So that's a related thing, but slightly different because you do have you've got an awful lot of treasuries in the world, and we're the we were the reserve currency, but now it looks like gold is becoming the world's reserve currency. Because in a period where you don't trust people, then gold makes a better money. Um, but yeah, there's an awful lot of treasuries out there, and there's two things about interest rates. One is just the benchmark where the 10-year treasury is, and the other thing is, the spread from that treasury to what interest rates people have to pay. And if we have too many treasuries out there and people don't want them, then our benchmark interest rate goes higher, or the Federal Reserve monetizes it to suppress it. Um, it's kind of amazing. So right now, the EU, their interest rates, their benchmark interest rates are 2%, and ours are 4.5%. It's a huge gap, right? They've cut, I think in the time period when we cut 3 times, they cut 10 or something like that. It's we're getting pretty far behind on the global cutting cycle, and Jerome Powell is holding the line. It's more than just holding the line. So from a malinvestment point of view, I think the benchmark interest rate is probably in a pretty healthy spot. But then when you look at the spread and you compare that with mortgage rates, so when mortgage rates were 3%, home builders built homes that were about 500 square feet too large compared to a normal interest rate environment. So when you raise interest rates, those houses are too big now. So if you have a starting family, well, they can't afford a 2,500 square foot house at a 7% mortgage. Right now, Jerome Powell is doing quantitative tightening. So he's still letting the mortgage bonds. Now, the Federal Reserve was never supposed to buy mortgage bonds. They broke the law to be able to do it. They got BlackRock to make this maiden lane entity, and they broke the law to buy mortgage bonds, but they did. Now Jerome Powell is letting them roll off. If instead of letting the mortgage bonds roll off, if he just held the amount steady on the balance sheet, even at the same interest rate, mortgage rates might be 0.75% lower, and that would be huge relief. So you're kind of making the housing market absorb all the pain of raising interest rates. And I think that's probably not necessary. Even if Jerome Powell didn't cut rates, at least he could stop quantitative tightening. And it's really you really have to wonder if there's some politics or some partisanship why Jerome Powell would still be quantitative tightening into this atmosphere. And a lot of it comes down to, well, academics are predicting that tariffs will cause inflation, but academic economists have been wrong about so much. I don't know why people are listening to them. If you just look at the hard data, the Fed probably should have stopped quantitative tightening a while ago. It would be easy for me to call for cutting interest rates. I think for long-term health and to not blow another bubble, I think these interest rates are the benchmark interest rates are pretty good, but the mortgage rates could come down if they just stopped quantitative tightening and stopped letting mortgage-backed securities roll off the balance sheet. I think that's putting the pain where it doesn't need to be.
Hmm. And so there's been a lot of criticism of Powell by President Trump, and I think Powell's term is up next year in 2026. I was
Yep,
reading
May
something earlier.
2026, we get somebody new.
Yeah, I was reading earlier where Waller may be the successor after Powell.
Yeah.
What's your take on him? Like, is he pretty dovish or
Well,
bearish or dovish or hawkish?
whoever it is has got to be ratified by the Senate, which I think the whole Senate would be on board with easy money, unfortunately, because it's not like there's any fiscal conservatives anywhere. I mean, you see Elizabeth Warren criticizing Powell constantly for having interest rates too high. So I think Republicans and Democrats would be sort of in agreement on lowering interest rates, which I don't even think is really necessarily all that good for the economy long run. But yeah, we're going to get somebody new. What was really interesting is Jerome Powell's second term. He was ratified by the Senate or reconfirmed by the Senate for 80 votes. And keep in mind, this is an administration. So you have, the Biden-Obama era was the weaponization of all government agencies. I mean, you have Lois Lerner, this is now proven fact, using the IRS to target Republicans and conservative groups. This is a world where every agency has to be weaponized. And you had the modern monetary theory crowd actually leaking Jerome Powell's personal trades to try and get him booted out of the Federal Reserve. And then with Democratic control of the Senate, they reconfirmed Powell. So that's a very powerful statement. I don't know. There's a guy named Tom Luongo who's better to ask about this stuff, but the people that are more into geopolitics say that we used to have these global interest rates. They were set in London, the London Interbank Offer Rate, LIBOR, and that's been replaced by SOFR. And SOFR is set by the Federal Reserve. So you used to have a bank rate that was set by the large banks out of London, and they cheated, and they were caught cheating. And they were manipulating the rate. Now you have the global interest rate set by the Fed, and with that power shifting from Europe to New York, the argument was, and I don't know if this is true or not, I think it was Tom Longo's argument, the New York bankers were not down with Klaus Schwab and Davos and all that crazy stuff. I mean, they were trying to use the banking system to ration capital to choose who gets, yes to floating windmills and no to petroleum and things like that. And that's not what central banks are supposed to do. The argument was that the reconfirmation of Jerome Powell, 80 votes in a Democratic-controlled House for what was originally a Trump-appointed Fed chair, that was New York taking back power away from Europe and raising interest rates. This phenomenon where the U.S. has 4.5% interest rates. Anybody who has U.S.-denominated debt, and there's a lot of it out there. So if you're a third world country, if you're Argentina, well, Argentina is not third world. I mean, they're doing a lot better now, but if your interest rates are too high in your own currency, you could get a lower interest rate in dollars. So a lot of sovereign governments have debt denominated in dollars. And this strong dollar policy with high interest rates devastating to those countries. And you also have this huge, massive amount of bonds called Euro bonds in the Euro dollar market. And there's this crazy phenomenon. I forget which, it was an Italian automaker in the 1970s. I forget it was Lamborghini or Ferrari, but one of them wanted to come to the US. And they said, but they went to New York to raise money and they wanted to issue some, I think it was Ferrari bonds. And in New York, they're like, we don't know who you are. So they gave them a really high interest rate. And so just on a whim, Ferrari went to London, and there just happened to be so much extra dollars in London. And in Europe, they were well known and they had a good reputation. They could borrow dollars cheaper in Europe than they could in New York. So it created this massive market that when a company borrows in a currency that's not the currency of that country. So if you're borrowing dollars in London, you're borrowing dollars in Switzerland. If you're borrowing yen in New York, if you're borrowing pounds, British pounds in Paris, whenever you borrow in a currency that's not the currency you're domiciled in, they're called Euro bonds. And it's very extra legal because most governments, like withholding taxes, the withholding taxes are only for transactions that occur in the currency of your own country. So you have this trillions of dollars of bearer bonds that have no record keeping in banks and Swiss vaults, but so many of them are dollar denominated. And if we have a strong dollar policy, those get really, really hard and really expensive to refinance. So this high interest rate policy is a sort of thing that could be crippling third world countries and crippling Europe with their Eurobond market and crippling European companies that issued dollar denominated debt. It doesn't cripple the United States because we can create new dollars, but countries that can't create dollars and have to repay debt at high interest rates. So one of the arguments is the US has these higher interest rates is that, it's might be a little bit painful for us, but because our citizens have these 30-year fixed mortgages and nobody else does, it's way less painful for us than it is for everybody else. And you see that most of the world has these 5-year floating rate mortgages. Canada has floating rate mortgages. Australia has floating rate mortgages. The UK has floating rate mortgages. I think only the Netherlands is one of the only countries outside the US that has a standard 30-year fixed. So for everybody else, we rose interest rates more than they had ever been raised in a relative basis. In an absolute basis, Paul Volcker raised interest rates more, but he went from 5 to 14. Going from 0.25% to 4.5% is a huge change because so much of that math is exponential. It ends up being a dramatic change to things. So I think the whole marketplace is just waiting to see when interest rates are going to get cut. And in the meantime, there's just so many parts of the economy that are struggling, whether it's the housing market, the equipment leasing market, the, sovereign nations that issued bonds in dollars, the euro bond market in Europe. There's just so many parts of the economy that are just paralyzed until we get some rate relief.
Yeah, yeah, definitely. I totally agree. Especially, I mean, when you look at consumers and I mean, credit card expenses and interest rates are still super high. Um, so just transitioning to, you mentioned gold earlier, so just want to get I know you've written about a few like gold miners and platinum miners and such. And so I know you're in the PGM space. Are you more of a do you do physical holding as well as royalty streaming, mining, or what's kind of like your balance or your philosophy there?
Yeah, so I haven't been bitten by the royalty bug. I know Ben DeMasi at the ROI channel, he's super into
Yeah.
royalties. I like things a little bit more high octane, and um, people don't like junior miners, and I think part of the reason was the last time gold prices rose in the 70s is it rose from cost push inflation. So the cost of mining rose as fast as the gold price, and the gold miners never made any more money. I think this time is different. I think this is demand pull inflation as a monetary asset. So you have, every year the cost of mining goes up. That's just the nature of mining. But it's gone up so much more slowly. And you have a lot of miners out there that their cost is $1,500 an ounce, and now they can sell it for $3,400 an ounce. So these junior miners are massively profitable now. And a lot of them, the prices haven't re-rated. So either people just hate mining and will never buy the stocks ever, or, people are saying, okay, it's too good to be true. Either the costs are going to rise or the gold price is going to fall. And I don't think those things have to happen. I think the gold miners could have really fat profits for a few years ahead. Um, the platinum group metals are different. So I look at the platinum group metals as an industrial metal, and the U.S. auto industry. So the guy who first really, I think, cracked the code on platinum group metals and that I know of is a guy named Trader Ferg, and he was the first person that made it aware that for one thing, Toyota was right. Hybrid vehicles are going to have a 10 or 20-year dominance over battery electric vehicles. And hybrid vehicles, because they have this start-stop phenomenon, they use 15% more catalyst in their catalytic converter than internal combustion. So instead of people were down on platinum group metals, say, okay, we're all going to be driving Teslas, we're all going to be battery electric, we don't need catalytic converters anymore. And the answer is we're going to have 10 or 20 years where we're going to use more catalyst in the catalytic converters because we're going to be driving hybrids for a while. And if that's the case, meanwhile, you have South Africa has intermittent electricity, and South Africa is something like 60, 70% of all platinum group metal mining. It's just everything heavier than iron came to Earth as an asteroid, and that's where the asteroid fell that has the most platinum group metals. So that's all in South Africa. Nature's really parsimonious with where it puts some of these minerals. You've got Kazakhstan has all the uranium, South Africa has all the platinum group metals. So there's three big ones to choose from, and I like Sibanye-Stillwater. What's interesting is, so there's three big metals in the platinum group metals. There's platinum, palladium, and rhodium. Now, palladium also comes as a byproduct of nickel mining, and Russia makes a lot of palladium. But in the past, that was the one that was $2,000 an ounce, while platinum was $1,000 an ounce. This time, platinum is moving before palladium. And I find that interesting because platinum, for one thing, Russia doesn't produce a lot of it with their nickel mining. It really is even more South Africa focused. The other thing is platinum is the only one that is used commonly in jewelry. And there's a phenomenon. So it's such a small market. If you compare it with gold, it's such a small amount mined every year. And if you look at, so one aspect is India's growth rate, is GDP growth rate is 7% a year. And it's becoming popular in India for grooms to wear platinum. So gold is the women's metal. Women wear gold. Now the grooms are doing their own thing and wearing platinum. That's enough to move the market in a huge way. Another thing is all the industrial catalysts for oil refining, for the hydrogen economy uses platinum. So and the Costco started selling 1 ounce platinum bars. In past gold cycles, silver was the poor man's gold. But now that you have this phenomenon where gold is $3,400 an ounce and platinum is, $1,000, $1,100, $1,200 an ounce, you might see a world where platinum is the poor man's gold. And again, there's a huge amount of silver mined for industrial purposes. There's a huge amount of gold mined. The platinum mining market is so small, it's such a tiny metal that Costco's platinum sales is enough to move the market. So if you have some upward move in the price and it becomes a phenomenon and people start talking about it on Facebook and all the boomers say, did you go to Costco and buy your ounce of platinum this week? It could really have a dramatic impact on a very, very small market with a very limited supply in South Africa with electricity concerns. So I'm pretty big on the platinum group metals. I've written about Sibanye-Stillwater a bunch of times on my Substack. I don't think any of it's behind a paywall. Sibanye-Stillwater, their CEO is retiring, so they're bringing in new management. They've made some decisions that some people don't like. They're highly criticized. I find some of their moves to be pretty good. So in finance, if you can decrease your volatility, you can increase your price. You can have multiple expansion. Sibanye-Stillwater wanted to decrease their volatility by being a third gold, a third platinum group metals, and a third battery metals. And what happened was the price of gold, the price of platinum group metals, and the price of lithium were all down at the same time. So it didn't matter if you were diversified across all these three areas because everything was down together. So that strategy just fundamentally didn't work. But now gold moved before the other three. So gold is now, ratcheting higher. And Sibanye-Stillwater produces about, I think, 700,000 ounces of gold a year at a relatively high cost. I think their cost of production was around $2,000 an ounce, which when gold was 1,900 an ounce was terrible. And now that gold is 3,400 an ounce is fantastic. So they're primarily a platinum miner, but they're profitable now just on the gold mining production, just that extra third. And they have a zinc mine in Australia. They have a lithium. They've got Europe's largest lithium mine in Norway. They've got a bunch of stuff, but you get a conglomerate discount if you try to do too many things. And I don't know if the new CEO is going to change strategy, affect some sort of spin-offs. They also have, so they have a massive multinational recycling component. And this was, I think, from the ESG era. They wanted to be responsible stewards of the metal from the mine to the recycling afterwards. And the problem with that is you get this good co, bad co framework. If you just took their recycling component and it was a standalone company and it was publicly traded, recycling companies fetch huge multiples, right? So just the recycling part of Sibanye-Stillwater at multiples that other recycling companies trade at, it would be worth more than the whole company. So I wonder if the new CEO, it probably won't, but it would be wonderful if it went in there and just, spun everything off, made it 3 or 4 different companies, and they all traded separately and, found their own multiple. I think there'd be a huge unlock of value there.
Hmm. Yeah. Yeah. So there's a quite, I mean, you mentioned quite a few points. So I was looking at the total market capitalization of platinum, which is around 200 to 250 billion, compared to gold, which is at, 16 trillion, and silver is at 1.7 trillion. So I can see how platinum could move further quicker because it's a smaller market. Um, but I do think that which I'm interested in your perspective, I do think that the wind is still in gold sales. Like I think in terms of the deficits and the debt continuously going higher. I mean, we just reached 37 trillion. And then we also have a lot more geopolitical tensions, and gold is typically the hedge against chaos. And so like it seems like gold and central banks still buying. And so like it seems like gold still has some wind in the sails, even though it's like leveled off. And so I'm thinking that there's still more room for some of the laggards like silver and platinum. I mean, silver just reached was it 37, 38 an ounce.
Yeah.
Um, I mean, and platinum's been on the rise too. And so do you think that these metals are going to go higher over the next, 5 years or whatnot?
I mean, the one that I have the most confident in going higher is platinum group metals. Silver is an enormous market, but silver is mostly a byproduct metal. So silver there are very few pure silver mines. Like there was one in Athens that supplied the treasury for Socrates and as a military veteran, he got one free meal a day. That was paid for by the silver mine in Athens. Most mines are not predominantly silver. Silver comes out of nickel mining and lead mining. So you've got this vulnerability to silver as an industrial metal that and nickel mining has been ramped up significantly for the battery electric vehicles. So it's kind of like, which race is going to win? Is it going to be the batteries for the cars, or is it going to be the solar panels? And then you also have the Chinese are thrifting, so figuring out how to use less of the metal in each product they produce. It's kind of a tough game to estimate, which horse is going to win the race, nickel mining or demand for silver. But platinum is much easier of a setup because the mines are in South Africa. South Africa has, electricity tightness. There's, very, very few new mines under development for platinum. And the demand is in these, internal combustion vehicles. It's in the, battery electric hybrids. It's in oil refineries. I think the demand is much more predictable. And then on top of that, monetary demand for platinum for people buying those, troy ounces, or jewelry demand for platinum really has the ability to go aggressive if it goes in vogue. You can't predict that platinum will go in vogue. So it's kind of just wishful thinking. But if grooms in India really go heavy into, I know I was a professor for a while. I kept asking my Indian students if they've been to a wedding recently and what was the groom wearing. One of them said, yeah, his father got remarried and he was decked out in platinum. So if that trend really takes off, India is such a large population with such an affinity for precious metals. That is more than enough to move the market.
Hmm. Yeah, yeah, yeah. That's good. That's exciting. So let's go ahead and transition to some other kind of sectors. And so I know we've talked quite a bit extensively about the silver tsunami. Um, and you we talked about Jackson Financial, which is solid company. I mean, we're like this is like a multi-year hold. Um, and
Yeah.
then you put out some recent pieces on ABL, Abacus, however, I forgot, I'm saying it wrong. I was reading your article on that
Yeah.
piece and just wanted to get kind of like your take on that company. Um, I was I mean, there was some recent like FUD that was brought out about it from a competitor because you had listed in your Substack the the top company, which was Coventry or something like that, and they were number one, and then ABL was number two, and then yeah, so it's kind of some interesting dynamics there. Like maybe there was some shady stuff going on with trying to compete with the number two guy that's on the rise to being that next number one or whatnot. But just want to get your overall take on that stock.
Yeah, there was a short report on Abacus Life, and when a short report is done right, you're uncovering the truth. And when a short report's done wrong, you're muddying the waters because uncertainty can cause prices to go down, right? Because, as a retail investor, you can read a 10K, but there's always stuff behind a black box that's not disclosed to you. So if they can drive uncertainty, if they can make things cloudier and muddier, you can get the stock price to go down. And this short report to me seemed like one that was, not trying to uncover the truth. It was really just trying to muddy the waters. But again, as a retail investor, there's a little bit of a black box there. So I do like Abacus Life. They're the public market leader it's called life insurance settlements. So there's this quirk of the US legal system, and it goes all the way back to a Supreme Court ruling over 100 years ago, that in the US, you own your life insurance policy. In Europe, that's not the case, right? In Europe, you don't have an asset that you own that you can sell in the same way you do in the US. So in the US, most people take out life insurance because they're, a 30-year-old man who has a mortgage and kids. And if they die, they don't want the kids and the wife to, go into extreme poverty. So they pay this policy. And then, one morning they wake up and they're 65 and they're retiring and their kids are graduated college and their mortgage is paid off. And they say, why am I paying for this life insurance policy? What do I need $1 million after I die for anymore? And they don't need it. And 90% of the time, people will just stop paying for the policy, not knowing that there's a residual value there, not knowing that they've accumulated some equity ownership in something. So only 10% of life insurance policies ever pay out, not because the life insurance policies are scuzzy and cheating people, but because people stop paying the premiums, especially after they retire. Because the purpose of it is to send the kids to college and pay off the mortgage. Once the kids are finished college and the mortgage is paid off, people say, I don't need this thing anymore. Well, a company will buy that life insurance policy from you. And Abacus Life is the public market leader. You can go to the life insurance company. So a lot of people just stop paying the payments. You can go to the life insurance company and ask them to, to close you out and settle you. But they offer you peanuts, right? So what Abacus Life offers tends to be about 7 times what the life insurance company. So maybe you have a $1 million policy when you die, and now you're 75 years old. The life insurance company offers you $50,000, and Abacus Life offers you something like $350,000, which is suddenly a substantial chunk of money, right? If you're 75 years old, would you rather have $1 million when you're dead in 10 years? Or would you rather have $350,000 today? There's an awful lot of baby boomers. Once upon a time, I was a financial advisor at Merrill Lynch, and you have your know your client rules, and I would always get people's financial goals. I would ask people about inheritance, and half of boomers do not really believe in inheritance. They've listened to Warren Buffett on his pledge, even though he's walked that back, and now he's increased the amount he's leaving to his kids. Turns out people like their own kids. But half of boomers say, I paid for college, they're on their own. So when you have a baby boomer who's 75 and has $1 million life insurance policy, would you rather have $1 million when you're dead, or $250,000 now, something like that? And I think it's pretty compelling to take that $250,000 now. That's called the life insurance settlement business, and it's part of that silver tsunami. There's this I think it's $75 trillion of wealth that's tied up with the U.S. baby boomer generation, and a big chunk of that is life insurance policies. And getting access to that money early is going to be, I think, a pretty big theme. And Abacus Life is there. They're the only one that's public. So the other companies in that space are either it's a one thing they do out of many, and it's not a pure position, or it's they're a privately held company. But it's a pretty exciting space.
Yeah, yeah, and they started off significantly recently. I mean, and I think there's a lot of move for upside. I mean, even I try not to get too caught up into like the price, the analysts and such, but I do kind of look at them just to see kind of their perspective, and even analysts are saying like, okay, yeah, the stock should at least double. Um, and so yeah, so it's definitely interesting reading those perspectives in alignment with yours as well. So yeah, it was a company I saw sold off, and I was like, okay, this is something I think is definitely providing some value. Um, so transitioning to another company, you had called a company, uranium company, Centrus, LEU. This was last summer. LEU is one that typically runs. I was looking at some of my purchase history. Back in 2021, I was buying LEU for $21. And then I didn't hold it. I sold it, when it popped, and then recently bought in when it was like $55, and then it popped to like $100. I sold it. I was like, yeah, this is way too fast. It's going up super fast. And then lo and behold, a friend texted me about it and asked, what do I know about Centrus Energy? And I went and looked at it, and it was at $190. And so I was just like,
Yeah.
wow. I mean, a profit is a profit in my opinion, but I think sometimes these companies do get ahead of themselves, and um, we've definitely seen, because even when you write your reports, in which everyone, I encourage you to go subscribe to Steve's Substack, which I'm gonna link to the description. But when you write your reports, you give like a estimated time frame of when you think your thesis or this price should a stock should reach this price. And we've had this happen multiple times in the uranium sector where the prices get ahead of themselves and then you get a significant pullback. We saw that recently in multiple different mining companies in the uranium space, as well as other companies. I mean, uranium energy or whoever you look at, like prices get ahead. And sometimes when I'm interviewing other guests on my show, like Rick Rule, like he has his price targets, and whenever the stock gets ahead of his price target and he in his time frame, he sells, takes profits, and then he waits for it to come down. That's happened multiple times over the last 3 to 4 years in the uranium sector. And so I'm wondering, like, okay, is this the move for Centrus, or is this going to come back down? Because it did go to like
Yeah.
120, I think, last year and came back down to 55, and then now it's at 190. And so just want to
Yeah.
get your take there.
I'm not buying any more here. I do think there will be a pullback because this is a story that's going to take decades to play out. This is not a week-long event here. So yeah, I think there's a good chance the price will pull back. But the whole uranium space. So last summer I kind of did a deep dive into the whole uranium space, and there's multiple stages, right? So you got the uranium miners, and I didn't find any of them that I really, really liked. And the next step after mining is conversion, right? You have to convert the uranium ore to, uranium hexafluoride. And there was only one private uranium conversion facility in the US. It's called Converdyne. Now, this one's interesting because is Honeywell. So Honeywell is about to split into three companies. And I believe the smallest of the three is only going to be about $1 billion market cap. So it's going to be a small cap materials company. And they're going to be, I believe, if it works out how it's supposed to, a 50% owner of the only uranium conversion facility in the United States, which, as we enter this nuclear renaissance, I think that's a big deal. And I don't think I've heard anybody else talk about it. Now, this uranium conversion facility is currently mothballed, it's closed, but it's licensed. It worked in the past, it could work in the future, and that would be 50% owned by, I believe, the smallest Honeywell split off entity from the spin off. So that one is one I'm going to watch. The next step after conversion is enrichment. And there's a couple companies in enrichment. So one of the famous ones is ASP Isotopes. They're doing this laser enrichment. But Centrus Energy was kind of the only game in town for a pure uranium enrichment company. And the problem with them at the time is they didn't actually do any enrichment because Russia had been subsidizing their enrichment so much that they had this massive monopoly on the space. So Centrus Energy was importing enriched Russian uranium and then delivering it to the utility companies in the US. And that's good and bad. It's good because they have these purchase contracts going out to the year 2040 because these uranium purchase contracts, their customers sign up for 15-year contracts. So Centrus Energy has the market. If you're a uranium enrichment startup and you want to get new customers, well, the whole market's tied up for 15 years. What are you going to do about it? So Centrus Energy has the contracts. I think that's super important. But they don't actually have any domestic uranium enrichment capacity because Russian uranium was so much cheaper. But they were putting things in place to create domestic enrichment capacity. So they have a facility that is licensed for enrichment, and it's pretty much they have extra reinforced foundation, and they have the ability to build centrifuges on it. And they've started deploying capital to build some centrifuges because they want to get some production online relatively quickly. But yeah, they don't actually have the capacity now. They're building out the capacity for when the capacity is needed. And then the US Congress put in a Russian import ban on uranium. And then Russia put an export ban on enriched uranium. So they said, haha, you're going to ban imports. Well, we'll ban exports. So there. So now Centrus Energy needs a waiver from the Department of Energy in the US, and they need a waiver from Russia to import the enriched uranium. And they have to do that for the next 2, 3, or 4 years until their own domestic enrichment capacity is online. And then I think by the end of 4 years, that's when the US import ban is officially ironclad and there are no more waivers given. So it was in a bit of a lurch when nobody knew if the waivers were going to be granted or not, or if Russia was friendly, because you have the Ukraine war situation and Russia's less friendly than they used to be toward the United States. But it looks like a lot of those dangers are past, and not all of them. I mean, there's still a chance that the waivers could fall through, and so there is some risk to Centrus Energy that they wouldn't be able to import the enriched uranium they need to in order to fill their contracts to get their own to get to the point where their own capacity is online. But other than that, you have, an entirely U.S. private company based on enrichment. And I put this in a paywalled article. So there's one other aspect to this. So there's low enriched uranium, LEU. That's their symbol, LEU, low enriched uranium. That's used for, civilian energy. These small modular reactors that Silicon Valley's excited about, they use HALEU, that's highly enriched uranium. So, or it's high assay low enriched uranium, HALEU. That's, I think, about 15% enriched. That's one part of the market. But everybody forgets the US Navy has been for the last, 70 years using highly enriched uranium, HEU. And in the Cold War, to produce enough plutonium for weapons, we made so much surplus highly enriched uranium that the US Navy hasn't had to acquire any for the last 30 years. Just imagine a fuel source so dense and so efficient that the US Navy just doesn't have to buy any for 30 years because they overproduced it. I mean, people who are against nuclear just don't understand it. It's just so shocking. But because of nuclear non-proliferation treaties, the US government is only allowed to buy their uranium from an American company. And that wipes out like 2/3 of the market. So, for example, Orano is the French company. There was a German company, but now when German ended their nukes, I don't know to what extent the German utilities still control the German company. But the Japanese have enrichment. But again, Japan is a country, and we can't buy uranium from a company owned by a country. So it has to be a US private company, which means Centrus Energy is positioned to become potentially a monopoly defense contractor. And I think that's why the multiples are getting so absurd, because if you look at like a Raytheon or McDonnell Douglas, if you get a monopoly defense contractor, your multiples get absolutely astronomical. So not just is it supplying uranium enriched for civilian power, not only is it for the small modular reactors, but it's also for the US Navy, and potentially being the only one to supply the US Navy. Now, there are some possible competitors, but they're already fully priced in. So the other competitor, it was the nuclear spinoff of this company, Babcock and Wilcox. So it's BWXT. What they did is they're the ones who would take the enriched uranium and actually shape them into fuel rods. But they're also expanding to get into the enrichment game. So the Department of Energy put out these grants for different companies to compete over. And BWXT is publicly traded, and they could potentially compete with Centrus Energy in the uranium enrichment space in the US. So it's not that Centrus Energy is guaranteed to be a monopoly, but with their contracts going out to the year 2040, tying up these customers, and they're, dominant, being a legacy dominant market position, they have a really good shot at dominating this market. You also have a lot of Silicon Valley startups, and they have some tricks up their sleeves. So you've got competition, but it's really volatile. I'm not going to buy any more Centrus Energy at 190 right now. Because this is something that's going to take years to play out. I mean, I think they're 4 years away from actually enriching. Maybe being unkind. Maybe it's 2.5, 3 years away from actually enriching their own uranium. There's a lot of chances for the price to drop in the next 2.5, 3 years on bad news events, or right now everybody's gung ho the nuclear renaissance, but the news cycle is going to come and go. Prices will go up and down. Centrus Energy, I think, is a really solid company with a few real risks, but I don't think the worst case scenario is going to come. And I think they have a pretty good shot at being a significant defense contractor 10 years from now. So yeah, I'd buy them, but maybe not at 190 today. I'd wait for a dip.
Yeah, thanks for sharing that. So how does like the way I'm thinking of this, I mean, you have this uranium process, it gets mined out of the ground. It has to go through multiple different processes, such as conversion and enrichment. Where does the miner's play into this because they have to supply the yellow cake, the yellow metal
Yeah.
to companies like Centrus. And
So
so, yeah.
I like mining. I think it's just something romantic about it. At least I understand the industry. It's easy to understand. I think a lot of my readers really like mining. I don't like lithium and I don't like uranium because I don't like things that can be mined with in situ practices. So you can just pump a bunch of water and solvents into the ground, dissolve the material, and then pump it back out. What that means is if you could get permitted, and the big problem with uranium is the local governments hate it. They think, oh, you're going to contaminate the groundwater, we're going to be radioactive waste. So maybe this fear is overblown, but for lithium, especially with in situ mining, supply can be brought online so fast that you're not going to have those years of high prices to pay for all the years of low prices. So I don't like the metals that can be slurped out of the ground. I think that's a losing proposition. So I don't like lithium at all. Uranium can be slurped out of the ground, but the permitting is a nightmare because the local governments hate it. So maybe the hatred from local governments is enough to restrict supply. But if we really wanted uranium, if uranium had higher prices, I think supply could come online faster than a lot of. So I would be a minority opinion with how fast I think supply could come online, as opposed to something like copper, right? If the copper bulls are right and we enter this period of $6 copper or $5.50 copper, it takes I mean, you're talking about a decade to get a new mine online. Whereas if you know where the uranium is, and uranium is not that uncommon of a metal in the Earth's crust, you can drill a hole, pump some solvents, and pump it back out. And it can be done relatively quickly if you have the government approval and the chemical supply chain. You've got countries like Kazakhstan's having problems with their chemical supply chain because it's we take things for granted in the U.S. that things work. You flip on a light switch and the lights turn on, and just big chunks of the world that don't actually work that way. But I I think Australia has enormous amounts of uranium, but I could be wrong about this. They have a uranium mining ban. If the price of uranium was high and we were in this nuclear renaissance and nuclear energy was finally perceived as a green energy and the government stopped fighting it, if Australia reversed their uranium ban and you have a very effective mining sector in Australia that could do in situ mining, I think supply could come online a lot faster than a lot of people think it could. So, so when I did my 3-part uranium series, I talked about the miners, but it wasn't the space that I wanted to be in. So last July, I said Centrus Energy was my pick. I think it was like $50 a share at the time, not 190. So I think a lot of that story is priced in at 190.
Yeah, yeah. So how does Centrus play in with so we have like the term market and the spot market. So are they locked into like a term contract where they purchase
Yeah.
their uranium from a company or whatnot?
So the Centrus Energy, the enrichment phase, it's all measured in these things called SWUs, these work units, right? So it's how much work it takes to enrich the uranium, and there's a commodity like price attached to these work units, but the contracts are very long term. So when a utility wants to purchase enriched uranium for Centrus, again, they have this multi-billion-dollar backlog going out to the year 2040. So they've got this massive 15-year backlog because they have these huge contracts. And I think that's fantastic. The only problem is they're planning on supplying those contracts with Russian uranium in the short term before they build up their own capacity. But they have started the works. They've started the process of getting their own capacity online because they weren't going to sit around and wait to see if the if they can get their quota filled for Russian imports for the entire 4-year period. So there are risks there, but yeah, it's very long term, all forward contracts. I don't think there's they did sell some. So going back to their earnings calls, there were instances when the management mentioned that they had unit price was very high, so they sold some extra on the spot market. So they're willing to dabble on the spot market if prices are high, but the vast majority of the business is these long-term contracts.
Okay, got it, got it. Okay, cool. Well, yeah, that's a helpful perspective to add to the pool of knowledge So I know we're coming up on an hour, but just want to get your take on just what are some of the general kind of I noticed like some of your pieces that you've been writing about recently, which you've been writing about it more than just recently. Some of them are, have to do with logistics to like some of the materials that are made for specific industries and such. And so, um, and I know you do like the deep dives on like the smaller cap stocks. And so, what are you seeing there? Because I'm kind of wondering like what does this domestic kind of businesses look like? Because we've had you know, like there's been talk about like the great kind of rotation from the larger caps into some of the smaller mid caps and such. And so, where do you think we're at with that? Just on a higher level perspective.
Well, I mean, I thought there was going to be a rotation to small caps a couple of years ago. Um, if so many people have these automatic buying programs from the S&P 500, I think a rotation to small caps is not guaranteed. But they're so undervalued if it were to happen. It's such enormous potential. And in the meantime, when they are so undervalued, if they're doing share buybacks, they're super effective. So there's an oil and gas company, which I just wrote about again recently, which has been a bit of a dud, but they've been doing share buybacks. And even though they've only been doing the tiniest amount of share buybacks, it's had a huge effect because their stock price is so low. But uh, there's so much uncertainty now. I thought this year was going to be a little bit, I thought Trump would be more predictable. Trump 1.0 was more predictable. This year has become so unpredictable. I've kind of been retrenching to say, what things do I really know for sure are going to happen? And one of the companies that I looked at, I fell into a rabbit hole where I was looking at the equipment dealership companies, and there were a couple that I liked. But one of them, the majority of their business is on trucks that work on the power grid, the transmission and distribution. And one of the things that we know for certain, I think that that's not really in doubt, is that after 20 years of exporting our manufacturing, we're finally in this time period where the power grid needs to expand. And so this company is called Custom Truck One Source, the symbol CTOS. And unlike almost every small cap industrial I follow, they're guiding and they're basing this off of their backlog. So they're basing this off of orders that they have to fill, but they're guiding toward 15 to 20% revenue growth this year, because one of the things we know for certain is the grid needs a lot of work done. And this company that provides trucks that work on the grid, Custom Truck One Source, is doing really well and projecting an enormous amount of growth. I got into this rabbit hole for the equipment dealership because and you saw this with Tesla. So when Tesla wanted to sell their cars, they had to fight with the dealership business model. It goes all the way back to the Great Depression. When manufacturing was scarce, the auto manufacturers told the dealers, if you want to be a dealer of our cars, you have to sign this multi-year purchase order. And when the Great Depression hit, well, then they couldn't make their purchase orders. But these dealerships, they were influential with their local governments. They didn't have any sway nationally, right? The auto manufacturers had national power. The dealerships had local power. So what the states did for the dealerships that were going to go bankrupt but were influential local businessmen is they gave them monopolies. So if you are in a city and it's like, John Smith Toyota or whatever, or it's, John Smith Ford is the dealership for that city, that's probably the grandson of the guy who got the monopoly in the Great New York. You've got this government monopoly power that's an asset that you can transfer to your descendants. So these dealership business models, they have this government enforced monopoly exclusive zone, which is kind of an interesting business model. And what that means is you've got this trapped area for parts and service, and it's trapped for a couple of reasons. With an automobile, with a car, you can go to pretty much any mechanic. Nissan will try to use proprietary software, proprietary lug nuts or whatever. They make it hard, but at the end of the day, you can probably find other mechanics to work on it. But a lot of times you're going to be really trapped in an area. So if you've got, you know, a diesel forklift or you have a dump truck or something like that, a lot of times you're really good, especially big with John Deere and Caterpillar. You have to take it to their mechanic. You have to take it to their dealership. And what that means, that's the real big profit center. So there was one company I liked and I've written about a couple times. I even had a call with management. It's Alta Equipment Group, ALTG. And they're really focusing on this monopoly aspect. And I think it's a longer story to play out. I think it needs more time than Custom Truck One Source. Custom Truck One Source doesn't have anywhere near as much of parts and service revenue, but they just happen to be focused on the one thing, which is the power lines, transmission, and distribution. That's one of the few things that I know that the US economy is going to do in a big way. The orders are placed. It's not going to stop for anything. It's not going to stop for interest rates. It's not going to stop for tariffs. It's not going to stop for Iran. We're going to be working on the power grid, and Custom Truck One Source is going to be flush with cash, and they're trading cheap.
Yeah, and just I mean, I was just asking ChatGPT a question like, what's the average age of the grids in the U.S. And so what it spit back out to me was that transmission and transformers, the average age of large power transformers are over 40 years. Over 70% of U.S. transmission lines are more than 25 years. And then when you get to distribution, 60% of circuit breakers are 30 plus years. And then some parts of the grids are date back to nearly 100 years. And there, what it said is that the upgrade cost of this is estimates are suggesting that it could be a 1 to 2+ trillion dollar cost by mid-century. And
Yeah.
so,
Oh,
just
it's a
thinking
long-term
about,
theme. It's taking decades, but the demand is not going away, especially if the data center artificial intelligence revolution. I mean, there are some data centers that are going to do power generation on site, but I think for most of them, they're going to be connected to the grid.
yeah, yeah, for sure. Yeah, that sounds like something that could definitely be. I mean, especially if they're already saying 20%, 15 to 20% revenue growth for this year, and having a backlog of like work that they have to do, that could definitely be something that could be a good investment to consider. Steve, thank you for coming back on the show and just providing so much value, as you are the unemployed value degen for the audience. And so, I'm going to link to your Substack in the description below. And do you have any closing thoughts for the audience?
No, yeah, no, thank you for having me, Daryl. It's always a pleasure. I'm still kind of digesting the fact that we dropped 12 bunker busters on Iran. I wonder what the world is going to look like over the next 10 or 20 years because of that. It's such a bizarre thing to happen. Um,
Yeah.
but I'm trying to yeah, I'll there's a lot of opinions out there, but I still don't know what to make of it mostly.
Yeah, yeah. There's definitely a lot of smoke and mirrors, and sometimes you gotta wait for the smoke to clear to kind of get like a clearer perspective on it. And so, yeah, for sure. Um, yeah, appreciate you coming on the show and everything, and let's do it again sometime.
Thank you very much.